It's June 2026, and across the United Kingdom, something is shifting beneath the surface of the property market, quietly but unmistakably. For the past 18 months, homeowners have been told a familiar story. Prices are resilient, the market is cautiously positive, and bricks and mortar remain the safest bet in Britain. But this month, that story is cracking. Estate agents are sounding the alarm. Major lenders are scrambling to reprice mortgages overnight. And two of the country's biggest property consultancies, Savills and Knight Frank, have just issued some of their starkest warnings in years. So what's really happening? Is this the long-feared correction finally arriving? Or is it something more selective, more surgical, that will hit some homeowners hard while leaving others almost untouched? Over the next few minutes, we're going to break down exactly what's driving this shock, who is most exposed, and, most importantly, what you can actually do about it, whether you're selling, buying, or just watching your mortgage deal tick down toward expiry. This is UK Property Compass. Let's get into it. Let's start with the headline numbers, because they tell a more nuanced story than the panic suggests. In the first week of June 2026, the number of sales agreed across the UK fell sharply compared to the same week a year earlier, down nearly 9% nationwide. In Northern Ireland, agreed sales nearly halved year on year. Outer London saw a drop of close to 20%. London, in fact, recorded some of the sharpest declines in agreed sales anywhere in the country. On paper, that sounds like the beginning of a crash. But here's the twist. And it's the part most headlines are glossing over. While fewer homes are changing hands, the ones that are selling are doing so at higher prices. The average price achieved per square foot actually rose from roughly £344 in April to almost £350 in May, an increase of around 1.7% in a single month. So what does that actually mean? It means buyers haven't vanished. They're still out there, with mortgages pre-approved and deposits ready, but they've become ruthlessly selective. They are no longer willing to pay over the odds for an overpriced, poorly presented property. But if a home is priced correctly, presented well, and genuinely competitive, they will move on it, sometimes quickly, and sometimes even in a bidding situation. This is what analysts are now calling a two-tier market. On one side, well-priced, well-marketed homes that are still moving, occasionally even attracting multiple offers. On the other side, overpriced stock sitting untouched for months, dragging down overall transaction numbers and creating the illusion of a market in freefall. And there's a reason so much stock is sitting unsold. According to recent industry data, the number of homes currently on the market in the UK has hit a decade high. Roughly 1 in 3 properties already listed has had its asking price cut, by an average of around 7%. Think about that for a moment. A third of all sellers in Britain have already admitted, in effect, that their original price was wrong. For context, just a year ago, agents were fielding multiple viewings within days of a listing going live. Now, in many parts of the country, that same property might sit for weeks, sometimes months, before a price reduction finally brings in an offer. This is the first warning sign for homeowners. The era of list high and see what happens is over. If your agent suggests an ambitious asking price to test the market, understand that you may simply be donating several months of your life to an empty listing, while the eventual sale price ends up lower than if you'd priced realistically from day one. If property prices are the surface story, mortgage rates are the engine running underneath. And right now, that engine is sputtering in a way nobody quite predicted at the start of the year. Rewind to January 2026. The consensus among economists was straightforward. Inflation was falling. The Bank of England was expected to start cutting its base rate from 3.75% sometime around the middle of the year, and mortgage rates were forecast to drift gently downward through 2026 and into 2027. Then came the conflict in the Middle East. The escalation sent oil prices climbing, which fed directly into swap rates, the behind-the-scenes financial benchmarks that lenders use to price their fixed mortgage deals. Almost overnight, the calm downward trajectory that borrowers had been promised was thrown into reverse. Swap rates spiked, and lenders had little choice but to push fixed mortgage rates higher in response. For a few tense weeks earlier this year, anyone coming to the end of a fixed deal was staring down the barrel of a significantly more expensive remortgage than they'd budgeted for. Now, here's where it gets interesting, and where this month's shock really crystallizes. As of June 2026, mortgage rates have actually started easing again. Major lenders, including some of the biggest names on the high street, have been trimming their fixed rates back down after those earlier hikes. For borrowers who'd resigned themselves to the worst, this has come as a welcome surprise. But, and this is the crucial but, experts are warning that this relief may be temporary and could even reverse. Why? 2 words: political uncertainty and inflation timing. On the political side, speculation has been swirling around the Prime Minister's position, adding a layer of unpredictability to the UK's economic outlook that markets simply don't like. Uncertainty at the top tends to translate into caution in the bond markets, and bond markets are exactly what drive those swap rates that mortgage lenders watch so closely. On the inflation side, the picture is genuinely tricky. UK inflation actually fell to around 2.8% recently. Sounds great, right? But that fall was largely down to a temporary reduction in the government's energy price cap. That cap is expected to rise again from July, which could push inflation back up, with some forecasts suggesting it could climb toward 4% by the end of the year. So what does the Bank of England do in that scenario? The bank held its base rate at 3.75% as recently as its April meeting, and most analysts don't expect a move at the next meeting in mid-June either. But here's the part that should make every homeowner with a deal expiring in the next 12 months sit up. Instead of the rate cuts everyone was expecting at the start of the year, some forecasters are now penciling in the possibility of a rate rise later in 2026, with some scenarios suggesting the base rate could edge up toward 4%, and in more extreme forecasts, potentially higher still. If that happens, it would be a complete reversal of the narrative that's dominated property conversations for the past 2 years. Instead of "rates are coming down, so wait it out," the message could very quickly become "rates went back up, and I should have locked in when I had the chance." This is why remortgage activity has already been unusually high this year, with monthly remortgage approvals hitting their highest level since late 2022. Homeowners, sensing the window of opportunity narrowing, have been rushing to lock in deals before any further upward movement. The takeaway for homeowners coming off a fixed rate in the next 6 to 12 months: don't assume that today's slightly improved rates will still be there in 3 months. The window for securing a competitive deal may be shorter than it looks, and many mortgage brokers are advising clients to secure a rate now, even months in advance, with the flexibility to switch to a better deal later if one becomes available before completion. Now, let's talk about the tax that's quietly reshaping who can afford to move house at all. Stamp duty land tax. Back in April 2025, the temporary, more generous stamp duty thresholds that had been in place expired. The nil rate band for standard buyers dropped sharply, from £250,000 down to £125,000. For first-time buyers, the threshold below which no stamp duty is paid fell from £425,000 to £300,000, and the upper limit for first-time buyer relief dropped from £625,000 to £500,000. In plain English, buying a home now costs significantly more in upfront tax than it did before April 2025 for almost everyone. As of June 2026, there have been no further changes. These reduced thresholds remain the baseline, and most analysts now expect them to stay in place for the foreseeable future. but that doesn't mean the squeeze has eased. If anything, it's become the new normal, quietly priced into every transaction. Consider a fairly typical scenario: a first-time buyer purchasing a property for, say, £350,000. Under the rules before April 2025, much of that purchase might have fallen under more generous reliefs. Under today's rules, that same buyer is paying stamp duty on the portion of the price above £300,000, meaning a tax bill that simply didn't exist for buyers at that price point 18 months ago. And for anyone buying a second property, whether that's a buy-to-let investment, a holiday home, or simply a couple who haven't yet sold their previous home before completing on a new one, there's an additional 5% surcharge on top of the standard rates in England and Northern Ireland. In Scotland, that additional dwelling supplement now sits at 8%. In Wales, the higher rate surcharge for additional properties is 5%. Here's why this matters right now. In June 2026 specifically, combine higher stamp duty costs with mortgage rates that may be near the bottom of a temporary dip, and you get a situation where the total cost of moving has quietly ratcheted upward, even while headline house prices in many regions have barely moved or even fallen slightly. For homeowners thinking about trading up, this means the gap between what my current home is worth and what it will actually cost me to move has widened. Even if your house has gained value on paper, a chunk of that gain may now be eaten up by stamp duty on the new purchase. Tax that simply wasn't part of the equation in the more generous threshold era. For first-time buyers, it means the deposit-saving goalposts have effectively moved. Many are now factoring in thousands of pounds of stamp duty that previous generations of first-time buyers in a similar price bracket never had to budget for. One of the most striking features of the June 2026 market is just how differently it's playing out depending on where you live. Nationally, annual house price inflation is running at a modest pace, broadly in the range of 1 to 3% depending on which index you look at, with the most recent figures from major lenders showing growth ticking up toward the 3% mark, the strongest annual increase in over a year. But that national average hides a sharp regional split. In many parts of northern England, annual price growth is running considerably stronger. In some regions, comfortably above 3%. These markets remain relatively affordable, buyer demand is steadier, and the stock-to-buyer ratio hasn't ballooned in the same way it has further south. London and much of southern England, on the other hand, are telling a very different story. Price growth here has been close to flat, and in some pockets, particularly higher-value London postcodes, prices have been edging downward. London also recorded the steepest falls in agreed sales of anywhere in the country this month. Why the divide? Affordability is the single biggest factor. In regions where average prices are already lower relative to local incomes, buyers have more headroom to absorb higher mortgage rates and stamp duty costs. In London and the South East, where prices were already stretched to the limit of what buyers could borrow, even a modest increase in monthly costs is enough to price out a meaningful slice of the buyer pool. And that shows up immediately in both transaction volumes and asking price reductions. There's also a structural issue specific to London. A higher proportion of properties there fall into bands affected by the additional stamp duty surcharges. Second homes, buy-to-let investments, and properties purchased by overseas buyers, who now face an extra 2% surcharge on top of everything else. Each of these segments has been disproportionately affected by the tax changes of the past 18 months, and London has more exposure to all three than almost anywhere else in the country. So where does this all leave the forecasts? At the start of the year, the major property consultancies were broadly optimistic. Modest growth, somewhere in the low single digits, was the expectation for 2026. Some forecasters were even penciling in growth of 2 to 3% for the year. That optimism has now been revised. Following the shift in the mortgage rate outlook driven by the conflict in the Middle East, one of the UK's largest property consultancies has downgraded its forecast, moving from an expected rise of around 2% for 2026 to now expecting average UK house prices to fall by roughly 2% by the end of the year. Crucially, they expect the sharpest price pressure to come over the summer months, precisely the period we're entering now, as interest rates are expected to be at their highest, and as mortgage offers secured before the rate hikes earlier this year begin to expire and get replaced with more expensive deals. Meanwhile, another major consultancy has taken a slightly different tone, describing the market as cautious but resilient, rather than forecasting outright falls, but still warning of continued downward pressure on transaction activity throughout the year. Their analysis of the latest transaction data showed sales falling between March and April, at a time of year when the market would normally be picking up momentum, not losing it. Both forecasts agree on one thing: the second half of 2026, and particularly this summer, is shaping up to be the most challenging stretch for the property market since the rate shocks of recent years. The longer-term picture, interestingly, is less gloomy. Beyond 2026, forecasts for price growth pick back up, with some analysts projecting growth returning to around 4% in 2027, climbing further into the late 2020s as the current uncertainty works its way through the system. In other words, this isn't being framed as the start of a multi-year collapse. It's being framed as a sharp, uncomfortable adjustment, a squeeze concentrated in 2026, particularly this summer, after which the market is expected to find its footing again. That's cold comfort if you need to sell or buy this year, but it does shape the advice that follows. So, with all of that context, what should you actually do, depending on your situation? If you're a homeowner planning to sell, price realistically from day one. With a decade-high level of stock on the market and roughly a third of listings already cutting their asking price, buyers have choice, and they're using it. An overpriced listing doesn't just fail to sell, it actively signals to buyers that something's wrong, even when the only thing wrong is the number on the board. Properties that come to market at a fair, evidence-based price are still attracting strong interest, sometimes even competitive offers, while overpriced equivalents sit untouched for months and eventually sell for less than if they'd been priced correctly from the start. If you're coming to the end of a fixed-rate mortgage in the next 6 to 12 months, don't wait and hope. The current dip in rates may not last, particularly with inflation expected to rise again from July as the energy price cap increases, and with some forecasters now discussing the possibility of base rate rises rather than cuts later this year. Speak to a broker now about locking in a rate. Many lenders allow you to secure a deal months ahead of your current one expiring, with the option to switch if something better appears before completion. Given the record remortgage activity already seen this year, you're clearly not the only one thinking this way. If you're a first-time buyer, the stamp duty changes from April 2025 are now the permanent backdrop. Factor the cost on purchases above £300,000 into your budget from the outset, not as an afterthought. On the positive side, the sheer volume of stock on the market, combined with a third of sellers already cutting prices, means there is genuinely more room for negotiation than there has been in years. Decade-high choice is a buyer's advantage. Use it. Don't be afraid to make an offer below asking price, particularly on properties that have already had one price reduction and have been listed for an extended period. If you're considering buying a second property, whether buy-to-let or otherwise, the combined weight of the additional dwelling surcharge, 5% in England and Wales, 8% in Scotland, plus a market where Savills is forecasting potential price falls over the summer, means the arithmetic on second properties has shifted meaningfully. This doesn't mean don't buy, but it does mean running the numbers with current rates and current tax rules, not the assumptions of 18 months ago. If you're simply watching from the sidelines, wondering whether to wait, this is genuinely the hardest call. There's a case that prices could ease further over the summer, particularly in southern England and London, giving buyers slightly more room. But there's also a case that mortgage rates could rise from here rather than fall, which would offset any price reduction, or worse, more than cancel it out. There's no universally correct answer here, and we'd encourage anyone in this position to run the numbers for their specific situation with a mortgage advisor, rather than relying on general market sentiment in either direction. So, is this a property shock? In some ways, yes. The reversal in mortgage rate expectations, driven by events on the other side of the world, has caught many homeowners off guard. The record stock levels and widespread price reductions are a real signal that the easy sellers market of recent years has ended, at least for now. But it's not the crash that some of the more dramatic headlines might suggest. What we're seeing is a market correcting itself, rewarding sellers who price fairly, rewarding buyers who do their homework, and punishing anyone on either side who assumes the rules of 2023 or 2024 still apply in 2026. The fundamentals, chronic undersupply of housing in many parts of the country, and a UK population that, by and large, still wants to own a home, haven't gone away. What's changed is the cost of getting there, at least for this year. If there's one message to take away from everything we've covered today, it's this. Don't make decisions based on what the market was doing 18 months ago. Make them based on what it's actually doing right now, and get advice tailored to your specific numbers, not the national headlines. That's it for this episode of UK Property Compass. If you found this useful, make sure to subscribe so you don't miss our next deep dive, where we'll be tracking exactly how this summer's mortgage rate decisions play out and what they mean for the autumn market.